If you want to make $100,000, $1 million, $100 million, anybody can do it. Welcome to Real Estate Market Moves, where we are going to cover everything you need to know in the housing market, commercial real estate, and the overall macroeconomic environment. So let's go ahead and jump right in and start with the weekly housing market report put out by the National Association of Realtor. Realtor.com is where you can get a lot of great information on the housing market, but the September 2023 monthly housing market trends report, the number of homes actively for sale decreased by 4% compared to last year. The total number of unsold homes, including those under contract, decreased by 7.2% compared to last year. Home sellers were less active this September, with 9.1% fewer newly listed homes compared to last year. The median home price increased 4%. Homes spent 48 days on the market, which is only 1 day longer than last year and 2 weeks shorter than before the COVID-19 pandemic. A lot of the housing market data you're going to want to go back and compare to pre-pandemic levels. So what we're experiencing in the housing market, with treasury yields being up, mortgage rates and mortgage yields are based largely off of the 10-year treasury, because that is the risk-free return investors can get versus investing in mortgage-backed securities or mortgages. The treasury has been up lately, pushing close to 5% on the 10-year, and that has pushed mortgage rates up to almost 8%, which further cooled the housing market and slowed activity down in the housing market, mortgage demand, home purchase price demand. And typically, seasonally, the housing market is going to slow down a little bit going into the fall, where people will generally, for the holidays, pull houses off the market. Things kind of slow down in the fall anyways. When you compound that with the mortgage rate lockdown that we're in right now, with people locked into low rate mortgages on their homes, that's putting further pressure on inventory levels. Inventory increased a little bit over August, but it's still historically low, well below pre-pandemic levels. And you can kind of see in this chart here where inventories typically are. Typically, we'll see about 2 million homes on the market at any given time. There's less than 1 million on the market right now. Listings are down, new listings, because interest rates are so high. People just aren't going to sell the houses. Demand has cooled a little bit. Some of the home builders are pulling back a little bit in some areas because they're not seeing the traffic with rates where they are, even with buy downs. But again, real estate is hyper local. So every market is different. So you really need to be in tune with your market. If you're looking to buy a home to live in, or if you're looking to buy properties to rent, you really want to pay attention to what's going on in your local housing markets and with commercial real estate, as a whole, because it can vary from state to state. But in general, interest rates are up, inventory levels are down, and there's still a lot of pent-up demand. So one of the questions and one of the theories out there is, if interest rates drop, that will spur more people to be interested in selling that have to sell for whatever reason. Insurance rates have gone up, taxes have gone up. A lot of the costs of owning and operating housing has gone up if you're an investor, commercial properties as well. And if you move, if you have to move because of a job, or if you have kids and you just need a house, and if rates come down, the thinking is from a lot of housing analysts and economists out there is that people will go ahead and list their house for sale. But there's so much pent-up demand that any drop in mortgage rates is going to bring buyers out of the woodwork back into the housing market and absorb any of the available inventory. So we still have an incredible imbalance in the housing market. We're at levels of unaffordability we've never seen in this country, or maybe going back 40 or 50 years. But it's a very unhealthy housing market. So pivoting to commercial real estate, basically what we've seen in commercial real estate, the CPI came out this week, and we saw that the owner's equivalent rent metric that they use for CPI showed that rents were increasing. That's something I've been talking about. There's been some talk that rents are coming down on a national average, and they may be coming down in some areas where there's more and more inventory hitting the markets, with more multifamily homes hitting the market. But in general, rents are going up in most areas for commercial and residential, because that's how the business model works. And as I discussed, insurance rates, taxes, operating costs, all of that's going up because of inflation on all properties, investment properties across the board. And the investors and the operators that are buying, owning, renting, managing those properties, the way that they offset those costs, increase the value of the property, is by raising rents. The other thing that's happening is cap rates are starting to rise because of the cost of the debt in that 10-year treasury. Investors look at a risk-free premium. If I can buy treasuries at 5%, why invest in real estate for the same return when there's risk? Although there are tax advantages to real estate as well. In news, other news about commercial real estate, the office sector is still under severe stress. Defaults are rising. Special servicing rates are rising, meaning properties that are at risk of default go into special servicing departments. So those rates are up in the numbers of properties that are on the list for potential default. The interesting thing is retail in some areas is doing well. Retail rents are up 20 to 40% across the board in Times Square, New York, of all places, ahead of the holidays. So you're going to see a lot of retail fill up ahead of the holidays. You might see some retail rents go up. And again, this is all very hyper local. So you have to look at the overall picture of your area, really know your market, because it's all very relative. As far as the macroeconomic outlook, talking about CPI coming out this week, came on pretty much on par, a little bit higher in the overall index than expected, but the inflation rate is still coming down from last year. Or the rate of inflation. So it's called disinflation, where the rate of inflation is coming down. Inflation is still up, but the pace at which prices are rising is coming down. So what does this do? So we had a stronger than expected jobs report. We had a higher than expected inflation, although inflation is still coming down. And we have the 10-year yield going up. So what does this do for the Fed? So right now the thinking is the Fed has come out and had multiple Fed speakers come out last week and say that interest rates are doing a lot of tightening for them. So they don't foresee having to do much more in terms of rate hikes, maybe one more this year. Right now, the markets are pricing in less than 10% of a chance of a rate hike in November at the next Fed meeting and a 30% in December, but we'll see what the next month's CPI looks like. That will come out in November for October. We just saw September's info come out. I figured September will be a little bit higher. As we know, food is higher, energy is higher, gas, oil, those types of things were higher, and rents were the big surprise for a lot of people, although, like I said, that is the business model of investors. Is raising rents to add value to the property, be able to refinance the property, offset those costs. So right now, what we're expecting is inflation to be sticky, the Fed to keep rates higher. So basically a new paradigm in terms of interest rate levels. Mortgage rates will probably remain higher than most people thought, longer than most people thought, which is eventually going to put pressure on investors and on owner occupants of housing that have to sell. You're going to start to see values potentially adjust in some markets. Other markets, properties are still selling in days, getting multiple offers. Other areas, we're seeing inventory start to stack up in markets like Austin and other markets like that around the country, Phoenix, Arizona, some of the Sun Belt areas, some areas in Florida, although some areas in Florida are red hot as well. So it's a very nuanced thing. It's a very local thing. So I wanted to bring you this real estate market update, real estate market moves, information that you can use in your business, in your life, whether you're looking to buy a house, invest in real estate, commercial, residential, whatever it is. You want to make sure that you understand your market, keep an eye on the rates, keep an eye on the availability of the debt and the credit, what the banks and lenders are doing, and to help you make your decisions so that you can, get that next house, build your portfolio, and, protect your wealth for generations to come.